Hello everyone, welcome to your Algo Lab. Today we're diving into a new strategy for backtesting the triple exponential average, also known as TRIX. If you haven't had a chance to watch our earlier episodes on technical strategies, we highly recommend checking them out. You can find the links to those episodes in the description below. Without further ado, let's jump right in. To calculate the TRIX, begin by computing a single exponential moving average, EMA, over a specified period. Next, calculate a double smoothed EMA based on the values of the first EMA, then a triple smoothed EMA from the second EMA. Once the triple EMA is obtained, the TRIX is determined by measuring the percentage rate of change of this triple EMA from one period to the next. This method smooths out short-term market noise and fluctuations, allowing a focus on longer-term trends. There are several ways to interpret the TRIX, but here we use the zero-line crossover. Since the TRIX represents the one-period rate of change, it effectively measures the direction of the triple-smoothed EMA. When the TRIX is above the zero line, it indicates that today's triple-smoothed EMA is higher than it was in the previous period. Conversely, when the TRIX is below the zero line, it means today's triple-smoothed EMA is lower than it was a period ago. With this understanding, let's dive into the backtesting. If you're enjoying our content, don't forget to like, subscribe, and click the bell icon to stay updated. Backtesting long-term signals can be challenging because traditional backtesting methodologies don't work well on long-term indicators due to the limited number of signals triggered. To overcome this, we look for commonalities across different markets, which helps guide us in selecting reliable indicators. In this episode, we'll be examining equity indices from around the globe. In later episodes, we'll explore other asset classes as well. From the United States, we have the S&P 500, the Nasdaq, and the small-cap Russell 2000. Moving to Canada, we have the TSX Composite. In Europe, our focus will be on the Eurostoxx 50, the German DAX price index, the French CAC 40, Spain's IBEX 35, Italy's FTSE MIB, UK's FTSE 100, and the Swiss SMI. In Asia, we'll examine Japan's Nikkei 225, the Hong Kong Hang Seng Index, and Australia's ASX 200. We've collected data starting from 1980. For indices that began trading after this date, we've used the earliest available historical data. We've chosen price indices because reinvested dividends can distort the calculation of the long-term moving average. Let's set up our benchmark. Our benchmark will be a buy and hold strategy on equity price indices. Here are the benchmark buy and hold returns. For example, the benchmark buy and hold return on the S&P 500 was 9.00%. Just a quick reminder, this is the price return without including reinvested dividends. Returns are just one facet of an investment. We also need to consider risk. Our preferred measure for this is maximum drawdown, MDD. Maximum drawdown assesses the risk of an investment by representing the maximum observed loss from a peak to a trough in a portfolio before a new peak is achieved. In simpler terms, it shows the largest drop in the value of an investment from its highest point to its lowest point. For instance, the maximum drawdown in this example is minus 25%. Understanding maximum drawdown helps investors evaluate potential downside risk and determine appropriate position sizing. Here is our table of maximum drawdowns for the buy and hold strategy. For example, during the testing period, the S&P 500 experienced a maximum peak to trough loss of 56.78%. The Nasdaq saw a peak to trough loss of 82.90% during the dot-com bubble. Finally, we have our risk-adjusted measure, the maximum drawdown adjusted return. The MDD adjusted return is the ratio between the annualized return and the maximum drawdown. While it is not the only risk-adjusted measure, it is simple and effective. For our long-term TRIX indicator, we are using the resampling technique discussed in episodes 4 through 6. In this approach, the data used to generate signals is resampled at each month end, while performance is evaluated on a daily basis. Here, we test a 3-month TRIX strategy, where the entry price is assumed to be the next opening price following the crossover of the TRIX and the zero line, with a 0.2% commission included to cover trading costs. We have highlighted the instances where the 3-month TRIX outperformed the benchmark for clarity. For example, with the S&P 500, the strategy did not outperform the benchmark in terms of overall return, but achieved a smaller maximum drawdown. Overall, while the average returns were lower compared to the benchmarks, the strategy effectively reduced the maximum drawdown. This is understandable as it helped avoid the most extreme periods of bear markets. In terms of risk-adjusted returns, the 3-month TRIX performed better across most indices. This consistency is crucial, as it suggests the indicator is effective across similar asset classes. Let's compare our 3-month TRIX strategy with the 10-200 moving average crossover, which we backtested in episodes 7 to 9, and the 10-month resampled moving average strategy tested in episodes 4 to 6. For these comparisons, we are using the S&P 500 as the underlying index. In terms of returns, the 3-month TRIX outperforms the other strategies. When it comes to risk, the 3-month TRIX closely aligns with the 10-200 moving average crossover and the 10-month resampled moving average strategy. Additionally, the 3-month TRIX generates fewer signals and has a higher win rate than the other two strategies. When developing a successful system, we rarely rely on a single indicator. The first step is to establish a sufficiently large number of profitable indicators. Given this approach, we're satisfied with the results of the 10-month TRIX. In the next episode, we'll conduct a simple grid search to explore whether we can further enhance our 10-month TRIX strategy. If you like our channel, make sure to like, subscribe, and hit the bell icon to stay updated with our latest content. Thank you for watching, and see you next time.